Welcome to Modern Farm Business Podcast. This podcast is designed to help the farm leader bring their business to the next level. We'll cover everything from leadership and finance to strategy and planning. I'm your host, Dean Hefta. On this episode, we're talking about financial metrics and some tools that you can use as you're leading your farm and making decisions in the operation. When you think about business, there's really a three-legged stool that keeps it solid. One of those is the things we make. The second is the fact that we have to sell those things that we make. And the third is we need to count the things happening in our business. So we make it, we sell it, we count it. The finance side of it, the counting side of it, can easily get put to the back burner because we have our to-do list of things that have to get done around making and selling in our business. William Bruce Cameron said, "Not everything that counts can be counted, and not everything that can be counted counts." And I think that's really important to keep in mind as we think about the financials. There's a lot of things that we can measure very specifically, and in our business, there's things that we can't measure really specifically. And that's where leadership comes in to know, hey, there's some things going on here that I need to make the decision with my gut. I just need to know it. But there are plenty of things that we need the facts in front of us, presented more clearly, and as a tool to help us do our planning for the future. When it comes to financials, just knowing and understanding the different pieces isn't enough. We have to really turn it into the doing, the how we go about making decisions and understanding our operation. Because when we separate the knowing from the doing, we really miss an opportunity to leverage that knowledge to move our farm forward intelligently. Today, I'm going to be going through some different areas that are important, some real basic fundamentals that are important to revisit and understand. And to do that, I'm going to be bringing in some insights from ag finance specialist at Water Street Solutions, Tim Brhel, to share some of his perspectives. So you'll be hearing from him periodically throughout this episode. To get started, Tim, give me some insights of what you've seen. You've worked with so many farmers throughout the Midwest, and you see different mindsets towards financials. What are some of the different mindsets that you see when it comes to a farmer's view of financials?
Yeah, that's a great question. I see a lot of different mindsets, and I'd really put it in view of a spectrum. So on one side, you have the farmer who does a balance sheet because the bank asks for it. He does his books only to generate what he needs for tax reporting. Really not a lot else going on with that, and honestly, if he had his way, he wouldn't do any of it, but it's something he has to do. That compared to the other end of the spectrum of the guy who's really proactive and open-minded in terms of how he's leveraging financials. So that's looking at the bookkeeping in a way that it drives information to him making decisions. It's having balance sheets proactively for the banker. It's also forward planning in his operation to look ahead into next year, not only in just a crop plan, but just to understand, hey, how's this next year going to turn out from this crop that I intend on planting, all the expenses, all the incomes I expect out of it, and how will that affect my balance sheet at the end of the year? And so they are forward planning, they're proactive, they're thinking about the decisions they make today and the impact that has in the future for them.
That's a great point. And our approach to the financials really drives how we end up using them on a day-to-day basis. Are we doing them for our own sake, or are we doing them for somebody else's sake? And when I say to myself, I really want to have a better view of the future, I want a clearer understanding of reality, I want to lay out a path forward, we're able to think differently about the numbers. We move away from them being a burden being imposed upon us by somebody else to turning them into a real tool that gives us power as business leaders. Let's start with thinking about three questions. Where am I? Where am I going? How do I get there? I believe those are really powerful questions to keep in mind. And it's good to have an analogy because financials are not that different than other things that we do in our life. Let's use an analogy like going on a trip. When you plan a trip, let's say you're going to Denver. The assumption is that you clearly know where you're starting at, but that may not be the case. Maybe you're meeting up with a friend to leave from Cedar Rapids, Iowa. That's where you're going to start from. And so you have to identify, where are we beginning from? And that really correlates with needing to know the current state of the farm. If I'm going on a trip, if I'm going to look at the future, I need to know clearly, where am I today? And so a good financial foundation clarifies what is the current state of the operation. The second step then is looking at, where is it we're going to? And that is, we're going on a trip to Denver. In the business of the farm, we're saying we're going somewhere in the future. We want to create some distant future that we're going to need to begin planning a trip towards. And that's going to include not only the longer term future, but also what do we need to accomplish in the short term, like next year. What are going to be those key gauges, the key metrics that we're going to work toward? And then that third one is, how do I get there? So once you have the current state, what's my financial state right now, and a picture of where is it that we want to work towards in the future, what does this destination look like? Now you can begin putting together a game plan like you would on a trip, where you're starting to lay out what's the route that we're going to be taking, what are the stops that we're going to be making along the way, and how are we going to adjust if we encounter construction in this area or we want to make a slight deviation. You're laying all that out so that you're more intentional about your trip. Now, once you're on the trip, you're going to be using, even subconsciously, many gauges. And this is just like on our business. There's many gauges that allow us to know how we're progressing, how we're doing, should we be concerned, how should we feel at any given moment. When you're on that trip, you're using things like your speedometer, you're using your gas gauge, you're using your watch, you're using a map on your phone maybe. Lots of things that continue to inform us of how are we doing on our trip. And that's where the financials, being on top of our financials of our business, really play on. They give us this info of how are we doing and what do we need to be getting prepared for. Today we're going to cover 2 documents and 4 different ratios that are important to understand. Now, the 2 sources of information we're going to talk about is the income statement and the balance sheet. Both of these are important for any business. And the income statement is a financial statement that reports on the financial performance over a specific period. It has different names, might be called profit and loss statement or statement of revenue and expense. The income statement gives a summary of how revenues and expense are occurring in the business. The second tool is the balance sheet. And the balance sheet is a financial statement that summarizes a company's assets, liabilities, and equity at a specific point in time. Essentially, it's a snapshot of what the farm owns, what it owes, and the amount that's invested by the owners. It follows the essential accounting formula of assets equal liabilities plus shareholders' equity. In it, you're going to have current assets, which can be converted to cash in under a year, and long-term assets, as well as current liabilities. Those are things that we have to pay within a year, and the long-term liabilities. To make the information more meaningful and comparable to things like benchmarks and to be able to watch trends over time, bringing ratios into it can be really helpful in bringing things to life. The ratios help us to normalize data and to make it more meaningful. So if I said I harvested 15,000 bushels off that field, that really isn't meaningful until I turn it into a per acre number. So I have to have something that gives me context. If I said the tank has 12 gallons of fuel in it, that means something different if I'm talking about a Toyota Prius versus my high horsepower tillage tractor. I need to have context, and that's what the ratios help us to do. And we're going to cover 4 different ratios. 2 of them are tied to liquidity and 2 are tied to solvency. And to introduce the concept of liquidity and our first ratio, Tim Brhel, give us some understanding of what does it mean when we talk about liquidity, and what are one of the major ratios that you look at around liquidity?
Yeah, so liquidity is really just the cushion that you have in your operation to weather bumps in the road. That's the way I like to describe it. And how I find liquidity is I'm looking at their balance sheet and I'm looking at current assets. So that's anything that would be from cash in the bank to grain in the bin to prepaids, looking at accounts receivable. That would be current assets. You subtract that from the current liabilities, which would be your accounts payable, anything that is due within the next 12 months, and those term payments. And so you subtract current assets minus current liabilities. That gets you your working capital. And then you divide that by the gross revenue that you expect to get out of that crop year. And that gives you a view of what liquidity looks like for your operation. And liquidity allows you to do two things. It allows you to seize opportunities when they come up, and it also allows you to protect your equity. And by that I mean if you have a bump in the road and you don't have liquidity, you're forced to sometimes sell assets at discounted rates. So an example would be now the machinery market isn't so hot, so I don't have a lot of working capital. Bump in the road comes, I have to sell a tractor for maybe half of what it's worth. That hits the balance sheet pretty hard, whereas if there was liquidity there, it wouldn't have to. So there's a lot to be said to have liquidity in the operation. From the positive side of seizing opportunities when they come up, and even from the hedging side of keeping your equity straight.
That's a great explanation. It is a key ratio for us to understand what's the cushion that we have. How do we feel on a day-to-day basis about our cash position from a liquidity standpoint? The other one that you hear people talk about is called the current ratio. And the current ratio is a different look on liquidity by measuring how able we are to pay our current debts. It's a ratio of our ability to pay the current liabilities. So let's say we had $500,000 in current assets and $200,000 in current liabilities. Well, $200,000 divides into $500,000 2.5 times, giving us a current ratio of 2.5. At a minimum, it's wise to have a current ratio of at least 1.5, which would mean in this case about $300,000 of current assets to cover the current liabilities. The other view is that around solvency. And solvency is my ability to pay all debts, including the long-term ones. Banks really look at this. And there's two key ratios for this, the first being the equity ratio. This shows how much your operation you own. Stating it very simply, you look at all the assets and all the liabilities and say what's left over. To get the ratio, it's really simple math. You take the equity and divide it by the total assets. If you have $600,000 in equity and the asset value is $1 million, well, voila, your equity ratio is 60%. You own 60% of the business, while a bank or some debtor owns the other 40%. A similar but slightly different view on this is the debt ratio. With the debt ratio, you just take the debt and divide by the assets. For this, the smaller the number, the better. So these are some powerful tools to get a sense of what's the health of my operation, and they are very helpful too when you move into the mode of forecasting and projecting future crop years. So right now, as you're planning the 2018, what it might look like on yield and price and revenues and expenses, it gives you the ability to say, how might my current state change in this future state? And you can begin now making changes to your plans, to your expenses, and things that you have going on. And so these becoming a part of your dashboard, a part of your trip gauges that you're using on a day-to-day basis to know how am I doing and how do I stack up, become very helpful. And they also give your lender much more confidence if you're speaking their language around financials. If you are more educated and understand on a functional level how to use the financial information, they're going to have more confidence in taking you on as a risk, because they know if these are being used in operational decisions, chances are the decisions being made are using more information and a more informed view of the business. So, final bit I want to hear from Tim. Tim, as you see people moving through a transition from maybe not using financials very actively to making them a much bigger part of what they're doing, what are some of the things that people need to keep in mind? What are some tips and tools for them to use as they use financials on a higher level?
So 2 tips. Narrow your focus and use that focus in your forward planning and decision making. So narrow your focus meaning there's a lot of ratios out here. I mean, and they're valid, but it's a matter of what are you as a business owner going to focus on and how do you apply it? So one good way to figure out what that is going to your bank and saying, look, you know my financial position. What do I most need to work on? Is it liquidity? Is it some other metric? And maybe those are the metrics that help you get ultimately better rates at the bank. But that can be your focus. And you take that and don't worry so much about everything else, but use that in your forward planning and in your decision making and start forecasting the year. Understand how all the decisions that you make leading up to the end of the year affect that outcome and try to drive towards improving that metric. And that's really the 2 ways that you can start building financials into your operation as more of a living, breathing thing that ultimately should get your operation in a much better place just by spending a little time to focus on one thing versus 25.
Thank you, Tim. And thank you to listening into this episode of Modern Farm Business. As always, send me an email at dean@modernfarmbusiness.com. You can find us online at modernfarmbusiness.com. And tell a friend about this episode and what we've got going on this podcast. We'll look forward to talking with you again next week about more financial concepts that apply to your farm.